Howdy folks, Mark here with Flipside Trading, and this is the video for the week of June 1st, 2018. Alright, lots happening. So the first thing we have to talk about is, we're focused on the long game. And the reason why we're focused on that, as you can see, we've always had, greater than 90% probability of success. Now, that probability of success is just that, a probability. You are going to get perturbations in the market that are going to go against that, and you're going to have trades that go against you, right? This is not an ATM. But the key is how you manage those trades that do go against you, with a plan. And if you adhere to that plan, then overall, okay, you still can maintain over the long term this type of profit margin success, right? We're over 18K, right, for the first half of the year. So, hopefully we're due between 36 and 40 K for the year. Here we are at 94%, and we're maintaining our goal of $1,000 a week. Okay, so we'll dive into that in a second. The other thing we want to take a look at, we have a wealth trade here, right? Why is this different? How we set this up? How we manage it. The key here is we don't do a lot of these, but when we do, they're usually pretty successful. And the key is that instead of making 5% on your money, we're making about 20% on your money, over a course of about a week or two. So it is lucrative, and you can see here that it definitely added to the bottom line. And lastly, I want to talk about this trade here on the SPX, just because it was end of the month, and some of the key things to look at end of the month. What's going on in the macroeconomic terms that help us make a decision to make that a call vertical versus a put vertical. Okay, let's get rid of these, and we'll go ahead and take a look at the charts. And let's see, where are we here? Here we go. All right, so we're going back to the SPX trade, the one that we had a loser on. And so even though you have a good setup, things can change. So let's zero in, and here we are. We're coming up to this whole idea of let's see if I can get this right. We're going to look right in here, and we can see coming down is that we have this, right, lower low, lower high, lower low, right? So we're definitely moving in a downtrend. As you can see that we're moving in that downtrend. You can see that price, okay, represented by these bars, is below all the moving averages, right? That's our bearish stack. We're below the 34, below the 21, below the 8. Now the key thing is this trigger here, as we're moving down, we also look at our momentum, right? It's also following the same thing, higher high, right? Lower low, lower high, coming down, downtrend. We also have a squeeze, which saying, hey, we have this overall consolidation. We're maybe looking for something on the downside, because you can see that this momentum is moving down as well, right? Momentum moving down, trend is down. The key is, and the key entry, for this trade was this break of the 200-day moving average. This is a very well-known support piece, and you can see that when we went ahead and broke that at this, basically 215 level. Right about here, right? 26.15. We didn't just go below it, okay, and run back up. We actually had some good hard momentum. I mean, we were just not running stops. We were all the way down, basically, 20 points below, that support line, which is definitely telling us that usually when you run stops, you go 3, 4, 5 points up and you push. So we did go ahead and enter, and we entered here. And we set the short strike back here at 26.50, and so the market kind of recovered a little bit after we set the trade, but we closed right here, okay? And we closed here at 26.26. We still had 25 points of cushion. So even though the trade was showing a small, P&L against us, we were still in great shape. So matter of fact, we opened up lower, right? We opened up all the way down here to 26.15. So now at that point in time, what that puts us 35 points away from our short strike. So we're seeming in really good shape, but the market takes a turn. So we're watching the market, and it starts driving back up. As it's driving back up, we're managing this idea of about 3x of max profit. So max profit in this trade was 375. We're watching it. I just wanted to make sure that we got up and, as we started approaching this, 2650, you can see that our momentum was also, at a very high inclined slope. We let it run for a little bit, but basically, we closed it in that $1,400, $1,500 loss range, which was in our parameters. Now, did that hurt? Absolutely. Do you like that to happen? No, but we're in the game, right? We lost 1,500. We still have over 18K for the year. We're still playing, still making money. We're going to let these long-term probabilities go ahead and, and take us to the promised land. That's the way this works. And so as long as you have a plan and you manage these trades that do go against you, and you can hold on and stay in and let time take care of its course, you can be successful selling weekly options and very successful at that. All right, so that's the first trade we want to take a look at. The next one we want to take a look at is BABA. So we'll take a look at the BABA. This is the wealth trade, right? This is a directional trade. And I'm going to go here and I'm just going to go blow this up. And so the thing about BABA, we saw that we have this whole idea of this resistance line. It keeps pumping up against, right? 1, 2, 3, 4 times. So this whole idea is that, you hear about different, formations. You hear about single tops, you hear double tops, triple tops. There is no such thing as a quadruple top, right? People don't really talk about that. So what we did is that we entered the trade upon the break of, this resistance right here. And I'll go ahead and show you, right? We entered here on this day. Now, unfortunately, even though we entered in and got above it, we closed back below it, which is kind of a warning sign. But the reason why we didn't get out of the trade is that we still held the EMA, right? We're still riding the EMA. So if we're closing below that, that's going to tell us to get out. So again, the next day, right? We come up, we get teased, we go ahead and break this key resistance and get pushed back down. We're staying down here, Now all this time, especially in these last, couple days, is that the market is pushing, right? Especially the Russell. So the market is, 20, 30 points up, and here our equity is really not following the index. So we're getting a little bit wary. So we decide that from a management standpoint, we're going to do the following. Is that when we get to this point right here, okay, is that we're not going to take the chance that it's going to hit this and drop back below, even though the index may be up. So we're going to go ahead and take half our profits. And that's what we did. We took half our profits right here at 240. Now, since this is a bullish trade, right, at 200, 205, and you can see that we approached the high of the day up here at 204.99. Hey, this is where we sold, right at the high, okay? This is basically where we contain max profit with this type of, credit spread. And we had some other reasons why we wanted to take profits right there at 205, and that's to do with fibs. So if we take the fibs here and kind of draw what we have, you can kind of see, let me blow this up for you a little bit. And we'll go like this. Okay, the key thing is our target is usually the 1.27 extension, right? So we came back up, and this 1.27 extension also corresponds with this high. This seemed to kind of be this, growing resistance point. So we wanted to make sure that we at least took some profit here and took some risk off the table. Now at 205, which was our target, which is why we set our short strike here, was the 1618. And that's exactly where we ended, and actually we pulled back a little bit here at the end of the day. But we basically sold out at the high to obtain max profit. We didn't want to hold this going on. It's like, okay, can it go further? It definitely can. I mean, you're starting to see a squeeze formulate here, which is a period of consolidation, which means that it could, travel sideways for a while. But our options expired on June the 8th, which was next week. And there's a little bit on the internals that made me nervous. And if I look back here at the internals, I want to look right here at we'll call it the skew. You can see that the skew, once it gets above 135, it has a propensity that when we get to this types of peaks, you can see that we usually take a little bit of a drop or a little bit of a pullback. In addition, we take a look at our put call ratio. We're kind of down here. We're starting to drift back up a little bit, you know, toward the puts, which is saying, yeah, in the long term it may go higher, but in the short term, you know, given our duration, given that we hit targets, we're going to go ahead and be conservative and take our money and hey, 20% profit. We're good to go. All right, the last trade that we want to talk about, we'll go back over here. We'll go back to SPX. 1 second. Where is that little devil? Here we go. Okay. So on the SPX trade, what we're looking at is, I'm going to go ahead and blow this up a little bit, and let's go right here. And okay, so we're basically trading in this range, right here. Now this range, we have this kind of overall resistance point, which was at the 50% retracement, but it also closed this gap, you know, right here, was pushing things down. Now, the thing to note is the Fed has this mandate where they're trying to get rid of their balance sheet, and basically at the end of the month, they're going to go ahead and sell off. So they had $9 billion worth of you know, bonds and securities they had to get rid of. And if you take a look at the other days, we'll zoom back out now, and let's see if we can get back out here. Let's go this way so you can see. Get a little tighter. Come across. So you can see if you look at the end of every month right here. Here's the 24th. Come all the way up to, you know, the 30th, down day, right? Why? Because the Fed's selling securities, tightening liquidity off the balance sheet. Here at the end of April, you can see, right? The Fed is doing their quantitative tightening. We're right here, pushing the market down. Go back to February, right? Go back to February, here we are, kind of, let's see, right at the end. Here's 27th, 28th, right? Fed pushing it down. So knowing the overall macroeconomics of what the Fed is doing, that they are going to go ahead and try to trim their balance sheet, there's a very, very high probability that we're going to go ahead and have a down or a sideways days, because the Fed itself is going to put market pressure, downward pressure on the market. So we went ahead, and you can see that we have a very, very key resistance point here. And we set this up for you know, 27, I think it was 27.50, and that served as our overall short strike. The market dropped down. Didn't have to worry about it. We were able to go ahead and you know, capture max profit. So again, using a combination technicals, right, based upon the support and resistance, fundamentals based upon the market, knowing what the Fed is looking to do on the macroeconomic side. And the overall statistics, this put us, you know, greater than a 70% probability. Before we entered the trade, we made sure the short strike was above that resistance, and now we get into that 90%, which gives us an edge to go ahead and make money. So that's how you work it. That's the long game, guys, right? We're looking for singles, doubles, and compound interest over time. That is the thing that's going to go ahead and really improve your balance sheet, improve your profitability, and really minimize your drawdowns. All right, thanks, and we'll catch you on the flip side.